Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts.
It's Thursday, February 12th, 2026, and this one was pure risk-off. The S&P 500 dropped about 1.6%, the Nasdaq slid roughly 2%, and the Dow was off around 1.3%. There wasn't one big macro shock. This was the market repricing the AI story, from upside hype to near-term earnings risk, and then dumping anything high beta sitting in the blast radius. On the S&P 500 heat map, it was basically a sea of red everywhere. And here's the key: the biggest blocks weren't saving it. Mega cap tech was down together, so there was no index level masking, no place to hide. The green you could find was clustered in classic defense, staples, utilities, selective healthcare, but it just wasn't enough to offset the damage from the leadership unwind. That heat map was the footprint of the rotation. Money moved like a textbook risk-off trade into staples, utilities, and REITs and away from tech, communication services, and consumer discretionary. Treasuries rallied alongside, reinforcing the cautious posture, and it wasn't just semis. The sell-off spilled into economically sensitive names tied to that so-called AI efficiency narrative, including parts of freight and transport, as investors reassessed who actually gets disrupted when automation shows up. Here's the tension the market traded all day. AI can still be the future, but the tape is locked on what it does to margins right now. Post-earnings air pockets in high beta names became the transmission mechanism, and mega caps derated in sympathy. At the same time, the picks and shovels side can still work in spots. The market's starting to separate infrastructure beneficiaries from application layer incumbents under pressure. And heading into the next catalyst, it's not just do we bounce, it's does leadership come back. Quick rumor and chatter check. Some of today's intensity got amplified by narrative fuel, desk talk about AI disruption spreading beyond pure tech, and chatter that sharp cross-asset moves can trigger forced selling. None of that is confirmed as one single clean driver. So treat it the right way, as unverified color that can influence positioning, not as a hard fact pattern. Alphabet didn't just sell bonds, it signaled how seriously it's betting on AI. This week, Google's parent raised about $31.5 billion in debt, its largest bond sale ever, to accelerate AI infrastructure spending, data centers, high-end chips, as the hyperscaler race heats up. For investors, the key point isn't leverage risk. Alphabet's rated AA+ and borrowed at very attractive rates. The message is capital allocation. Management is choosing speed over caution, locking in long-dated funding while markets are wide open and demand is overwhelming. They even issued a rare 100-year bond, underscoring how investors increasingly treat hyperscalers as long-term infrastructure, not cyclical tech. The trade-off is clear. Interest expense is rising, nearly $300 million last quarter, and long-term debt has jumped. That helps explain why Alphabet stock is basically flat year-to-date, despite strong fundamentals. Markets are digesting the scale of spending, not questioning solvency. The bull case now hinges on execution. Alphabet says AI is already lifting search activity and cloud revenue. If those trends compound, today's debt-funded capex becomes tomorrow's margin expansion. If not, the payoff just gets pushed further out. Bottom line, this bond sale isn't a warning sign, it's a statement. Alphabet's using its balance sheet as a strategic weapon. For shareholders, the question isn't whether Google can afford AI, it's how fast that spending turns into durable growth. Apple was the psychological crack. Apple dropped about 5% on the day, and that kind of move from the market's biggest bellwether changes behavior fast. When the so-called safe megacap isn't acting safe, traders stop debating narratives and start cutting exposure. That kept the Nasdaq on the back foot and reinforced the broader de-risking tone. CSCO was one of the clearest why today mattered prints. CSCO dropped roughly 12% after a profitability and margin disappointment. And that fed directly into the session's bigger fear in the AI arms race. Spending and competition can squeeze margins even when demand holds up. It wasn't just one stock. It became a transmission mechanism for a broader de-rating. AAPL made the new rule painfully obvious. APP plunged close to 20% despite strong results. The market reaction wasn't about demand disappearing, it was about durability and margin risk in an AI-shaped competitive landscape. In this tape, a good quarter just isn't enough if the forward profitability story looks threatened. NVDA was the AI barometer, and it didn't offer shelter. NVIDIA finished in the red as the semiconductor complex got hit, along with the rest of high beta tech. When NVDA is down on a down index day, it sends a clear message. Traders were cutting AI exposure broadly, not just rotating inside. One important exception showed up in AI infrastructure. EQIX jumped on upbeat guidance, and it highlighted a real split: data center and infrastructure beneficiaries on one side, application layer incumbents under pressure on the other. On a day when the market sold the AI narrative, EQIX reminded investors the picks and shovels angle can still catch bids. Finally, a cross-asset tell. Silver via SLV was down double digits, and gold and silver weakness got flagged as cash-raising pressure. That kind of move isn't typical background noise. It fits a session where liquidity preference jumps and selling spills outside equity.
Next up, the key catalyst, Friday's US CPI inflation report. Rates already moved in anticipation. Treasuries rallied, and the 10-year yield slipped to about 4.11%, the low for 2026. The near-term setup is basically binary. The print either validates easing expectations and helps stabilize duration-sensitive growth, or it forces another reprice. Either way, the real tell is leadership. Do the big tech leaders actually come back, or do defensives keep winning? So that was the day. A hard risk-off session, weak breadth, and a very clear message. The market is treating AI as an earnings risk story right now, not just a growth tailwind. Defense won, staples, utilities, REITs, while high beta and megacap tech derated. Now the market gets its next signal. Watch CPI, watch yields, and most of all, watch whether leadership actually comes back. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.